There's one piece of financial advice I hear constantly in Switzerland. In expat Facebook group, in finance forums, from colleagues at lunch, sometimes even from people who should know better. And the worst part, it sounds completely reasonable. And it sounds smart, it sounds safe, it sounds like something a responsible person would do. But for a lot of people, maybe most people, it's basically the wrong move. And today I'm going to tell you exactly what it is and why it is so dangerous and what to do instead. Hey, it's Charlene Cong, and this is the channel where I share my 10 plus years in banking and finance experience with you all for free. Like and subscribe for more content like this. So what's the advice? The advice is just buy the S&P 500 or sometimes just buy a global equity ETF and hold forever. You've heard it and maybe you've said it or maybe you're doing it right now. And look, I'm not here to tell you that the S&P 500 is a bad investment. It is not. So the US stock market, for example, has delivered roughly 8 to 10% on average annual returns over the long term, right? So a global equity ETF also gives you broad diversification across hundreds of companies. So these are not bad products. But here is the problem. A product is not a strategy, and just buy this and hold forever is not a plan. And it's basically the noise dressed up as wisdom. And let me show you why with 3 real examples. So imagine 3 people all living in Switzerland and all earning good salaries and all ready to invest. And person A, and she's 28, single, no kid, and she moved here from, for example, Asia 2 years ago, and she earns around 120K per year, and she saves aggressively. And her goal? She wants to retire early, and maybe in her late 40s instead of 65, and start her own business. So timeline, like 15 to 20 years. So for her, a heavy equity portfolio with high growth exposure actually makes a lot of sense, right? So she has time, she can ride out volatility, and she doesn't need the money anytime soon. So okay, I would say a risky investment suits her. Now let's say person B. So he is 50 and he and his wife are both working and they have 2 kids. So one starting university in 3 years and they own a property and have a mortgage. And his goal, so he wants to retire in 10 years and he wants to help fund his kids' education and he wants to protect what he's already built. So timeline, 3 years for educational costs, right? And 10 years for retirement. And now ask yourself, should he invest exactly the same way as person A? So a 100% global equity portfolio or S&P 500. So if the market drop, so let's say 40% in year 2, which has happened before and it can happen again, right? So what does he do? And he can't wait 15 years for recovery. His daughter needs tuition in year 3 and his retirement is in year 10. So he will be forced to sell at the worst possible time, right? So that's not investing. That is basically gambling with your life plan. And now let's talk about person C. So a family, 2 incomes, 2 kids aged 5 and 8, and they want to buy a bigger apartment in Zurich in 5 years, and they need probably around 200K for the down payment. So that 200K is sitting in their savings account right now. So someone helps them put it all in the S&P 500. So it sounds logical, better return than a savings account, right? But in 5 years, if the market down, which again has happened before, they cannot buy the apartment. Or worse, sell at a loss and end up with 150K instead of 200K. So the advice didn't fit their financial situation and their goal. It didn't fit their life. So this is the mistake. So not that S&P 500 or a global equity ETF are bad. The mistake is treating investing like a one-size-fits-all solution. So as if someone's life looks like the same, as if everyone has the same timeline, everyone has the same goals, the same risk tolerance, the same family situation. But actually they don't. and you don't. And this is why I get so frustrated when I see people in online groups asking, oh, what should I invest in? I'm a total beginner investor living in Switzerland, and the answer is S&P 500. Done. Next question. So because no one asked, what is this money actually for? And when do you need it? And what happens to your life if it drops, for example, 10% or 20% or more? The right question isn't what is the best investment. The right question is, what is the best investment for you right now, given your life and financial situation and your investment goals? So those are completely different questions. And the answer changes based on your age, your income, your goals, your wealth, and your timeline and your financial situation, your family situation, your tax position here in Switzerland, and how you actually behave when markets get scary. So I would say 100 people should have 100 different investing strategy, unless everything of the two persons are the same, which is almost impossible. And to be very honest with you, that is exactly why I'm here today, why I'm doing this, investment coaching. And that's exactly the reason why I built, our own vision investment framework. So I just want to be 100% transparent. So the full program actually is a paid program, but today I like to use the framework to give you a free overview of how I would build a personalized investment strategy based on my own situation, instead of simply buying the S&P 500 or hoping for the best. So I'm not here to give you a stock tip. I'm not here to tell you which ETF to buy. I'm basically here to give you a structured framework so you can build the right investment strategy for your own life. So what does a real investment strategy look like? So 5 steps. In order, no shortcuts. So step number 1 is value and goals. So before you touch on a single product, you get clear on what you actually want your money to do. So not that I want to get rich. Be more specific, realistic, and time-bound. So for example, do you want to retire at 50? Buy a property in 5 years, or fund your child's university, build a second income stream. So each of these goals requires a completely different strategy. And this is the step I would say 99% of people skip. They go straight to what should I buy without even asking, what is this money for? And step number 2 is investigation. And now you will learn what is actually available to you. Not just some hot stocks and ETFs or, the particular theme or sector that you believe, for example, AI, those hot, technology sector that you believe will do well this year. For example, in investment, we have stocks, bonds, alternatives. And within stocks, we also have DM stocks, which means developed market stock. EM stock means emerging market stocks. We have US stocks, Europe stocks, Asian stocks. We have growth-oriented stocks and value-oriented stocks, right? And bonds, within bonds, we have high-yield bonds, we have investment-grade bond, we have corporate bond, we have government bond. And within alternatives, we have, let's say, private equity, we have real estate, we have REITs, we have cryptocurrency, we have gold and silver. So I'm not here to overwhelm you, saying that you have to be, an expert in each of them. No, you don't. For example, in my previous job at J.P. Morgan, next to me, actually, the seat he sits next to me is Asian high yield specialist. So what I wanted to say is that in the banking world, people are really specialized in certain things. But for people like you and me, like private investor, you do not need to, know every single detail of everything. But most important for you is to understand how each of them, for example, what are they? Right? And what are the pros and cons for each of those investment options that I just mentioned? And most importantly, how they perform during different market cycles and how they fit your short-term, mid-term, long-term goals that we just, finalized, we just defined in the first step. And now we talk about, step number 3, which is strategy. So only now, after step number 1 and 2, so after you define your finance goals, right? Short-term, mid-term, long-term goals, and you understand different investment options and you understand the pros and cons of it. And now you build your own personalized investment strategy, not copy from someone else, not based on what worked for your colleagues or neighbors. Build for your goals, your timeline, your risk tolerance, your life in Switzerland and beyond. For example, let's go back to our three persons. Person A, she's young, she has long timeline, high growth goals, might be comfortable with, for example, 80% to 90% in equities, like some high risk investments. And for person B, who has 10 years to retirement, educational costs coming, needs a more balanced portfolio, a balanced approach, and some growth, some protection, some liquidity. And for person C, who has a down payment needed in 5 years, probably shouldn't have that 200K, everything in volatile equities at all. So here they have the separate strategy that fit their own life. And now let's talk about step number 4, implementation. So now you execute consistently, calmly, without panic. And this is also where you learn which platform to use, how to minimize fees, and how to actually place your first trade. And step number 5 is optimization. So over time, you refine, you review your allocation as your life changes, and you optimize for taxes legally here in Switzerland, and you automate where possible, and you rebalance when needed. Because a strategy that was right for you at 30 may need adjusting when you are 40. Because your life situation changes and your goals might change as well, right? So maybe now you're single and next year you fall in love with someone and want to have a family and raise a kid together. So your financial situation changes. Your investment strategy should be optimized accordingly as well. So investing is not like set and forget, but it also shouldn't consume your life. So the goal is like a system that runs quietly in the background while you're focusing on living your life. So here is really what I want you to take away today. So the worst financial advice isn't obviously bad. It is the advice that sounds sensible, that's repeated constantly, and happens to be completely wrong for your specific financial situation. Just buy the S&P 500 isn't bad advice for everyone, but it's not good advice for everyone either. And applying it blindly without understanding your goals, your timeline, and your risk capacity is how people end up either, missing their targets or panicking and selling at exactly the wrong moment. You deserve better than that. So if you have some savings in your bank's account, you want to make it work harder for you. And if you want a strategy that actually built for you, I would say Vision Investment Academy is exactly that, guiding you from 0 to 1, including all the steps that I just mentioned in much, much, much more details. A structured step-by-step system for busy professionals in Switzerland with no finance background. So we actually don't accept everyone to join this program, but if you want to learn more about it, and you can find more information in the video description area and see if you're a fit. So until then, I will see you in the next video.